Let's get across the market open now. Josh Barker joining us from Barker Wealth. Josh, welcome back to you on this Friday. Development overnight, of course, being that reaction to Yemen's Houthi striking oil tankers in the Red Sea. Oil prices now back above $100. That's been a big drag, particularly on equities.
Yeah, I think that $100 mark has been quite significant. You know, when we saw it hovering above and below that number a little while ago before things seemingly calmed down. We're back there now, and yeah, I think it's definitely negative for global equities, but I do feel that Australia, in particular, the economy and obviously the share market by extension, is most susceptible to that oil price and the conflict escalating. So yeah, some interesting times in the market. There's plenty happening. You know, we've seen Trump look to potentially re-escalate the tariff talk and increase, tensions there whilst all this is going on. But I think the big difference at the moment is what's happening with the question being asked about AI spending so strongly. We've seen these, we've seen oil prices quite high, we've seen tariffs come through, but the corporate story, particularly in the US, has always been quite strong for probably the past 3 years. So we're seeing that really come into question now with the amount that they're spending. Microsoft looking at spending $200 billion in just 2026 alone. So yeah, some big numbers being thrown around, but it's something that it's sort of a necessarily pain in the short term. If anyone's going to spend that amount of money on that particular area of capex, it's going to be the well-capitalised companies. The Mag 7 are best positioned to do it. Better than some company coming from nowhere raising capital to go and do it. So it's something that needs to happen for the thematic in general for the long term, and I think that it's a good thing that those companies are doing it despite the short-term pain.
So, Josh, just focusing on Wall Street and those moves, obviously, given the market reaction to what we heard from Alphabet, I mean, Tesla also taking a huge hit as well. So,
yeah.
What are you seeing there as far as the investor reaction is concerned? Because the concern is just how much money is being spent on this and whether they're going to get those returns or not.
Yeah, exactly. Well, I think it's one of those things. It's like mining companies when they spend capex, right? It does hurt the balance sheet, but it's something that needs to be done to get those future revenues. And I think probably just as safe it is to take something out of the ground. It's just as safe to sort of invest in this AI thematic moving forward. So I think it's going to be good for these powerful companies long term. There's been, for years, we've spoken about the cash that these companies are sitting on. Apple's the most famous example of that. Now's the time that they sort of deploy a lot of those cash as we sort of enter what's really a revolutionary sort of cycle in technology. So I think that these companies are best positioned to do it. I think they're the ones that should do it, and I think that it's only going to reaffirm their dominance over the long term. So yeah, you'll see earnings compression, and I think that that's a really good allocating in opportunity for these companies to hold in your portfolio long term.
All right, let's refocus then on the local market. Now, you're saying that we're perhaps most susceptible to in terms of what's going on in the Middle East, given those oil prices are back above $100. And on top of that, as you mentioned there, the Trump administration now slapping 12.5% tariff on Australian exports. Where do you see the points of pain at the moment? Yeah,
well, all that, and along with the labour data that came out and that market being quite tight, points to an environment where we're potentially looking at another rate hike before the end of the year here locally. At the same time, we're looking at a rate hike in the US. So that's probably going to hurt us double time in terms of our market here. So I think, yeah, the share market for the year is largely flat probably by the end of today for the calendar year to date. And I don't really see that changing too much. I don't think the return on the ASX for 2026 calendar year in its entirety is going to be unlikely to be a positive one, let alone a strong one. So it's really interesting times. I think there's certain areas of the market that have been quite beaten up. A lot of our healthcare and discretionary stocks have been quite hurt. Very different stories though, so I think the discretionary is probably going to continue to come under pain, whereas maybe healthcare finally shows its resilience. But there's areas of the market that are still going to be quite positive. We've got really good miners, we've got a lot of really good commodities coming out of the ground, and I think that's what makes our market so unique, and I think that's where the strength will need to come from to prop up the index.
Clearly energy benefiting, given what's going on in the Middle East. How do you view that? And in particular, I know you've got your eye on uranium. What are you seeing there?
Yeah, I think that's, we've obviously seen the oil price be in the headlines with the conflict, but I do feel that there's also the uranium story and the price of that likely to accelerate with the conflict. So Trump said that he's eyeing off Pickaxe Mountain, which is a large facility that they've got there in the nuclear space. So it's really going to create less supply if those attacks do come, which, I guess it's hard to read into what Trump says, obviously, too much, but the language that he's using doesn't seem like parties are going to come back to the table anytime soon, and things are only going to further escalate. So I do think that's an area that's likely to be positive. Paladin had a really good week this week on the back of not only the commodity price, but also the company performing quite well in terms of upping its production numbers too. So I think those pockets of the market where we're taking it out of the ground and selling it on, despite the fact that we don't use it here locally due to our policies, we've still got that huge supply reserve.
So, now Josh, I've asked you this before, given what you're seeing in the Australian market, whether you're sort of lessening your exposure here. If so, where are you deploying that capital in?
Yeah, well, I think the really obvious one is starting to take up an allocation in some of those Mag 7 stocks. Microsoft is probably a clear example. It's had a lot of divergence between its top line revenue and its share price, which historically has tracked quite closely together. Obviously, the reason for that is the earnings growth not quite being there, but I don't suspect that will be a long-term trend, that its earnings are going to compress for the company. So that's actually one that I'd be sort of open to taking a company-specific play on over in the US. Tesla's a little bit of a different story. I think that their miss was a little bit more company-based rather than just purely blaming the AI spend. And it's a lot more of a binary, volatile stock, along with its other company on the market as well. So I think that one I'd probably steer clear of, but those really stable names that are spending that, and you see those opportunities where the stocks are down 15-20% from their highs, like I think Microsoft just about is, those are the names that you can look to pick up.